Hi, everyone. I'm Tomer Dicturel with Crossfield Strategic Partners. Today, I want to break down the basics of three common types of life insurance: term life, whole life, and indexed universal life, or IUL. Whether you're just getting started or revisiting your coverage, understanding how these products work is a useful foundation for any conversation with your financial advisor. Let's start with term life insurance. Term is the most straightforward form of life insurance. You purchase coverage for a defined period, typically 10, 20, or 30 years, and pay a level premium for that term. If you pass away during the coverage period, your beneficiaries receive the death benefit. If you outlive the policy, coverage ends and there is no payout. There is no cash value component in a standard term policy. Term life is generally the most affordable type of life insurance for a given death benefit amount, which makes it a common choice for people seeking coverage during specific life stages while raising a family, carrying a mortgage, or building a business without a long-term premium commitment. Next is whole life insurance. Whole life is permanent coverage, meaning it is designed to remain in force for your entire life as long as premiums are paid. Premiums are typically higher than term, but the policy builds cash value over time at a rate set by the insurer. That cash value grows on a tax-deferred basis and can be accessed through policy loans or withdrawals, though loans and withdrawals reduce the death benefit and cash value and must be managed carefully. If a policy lapses with an outstanding loan, there may be tax consequences. Whole life is often considered by people who want lifelong coverage combined with a cash value component that grows at a predictable, contractually defined rate. Now let's talk about indexed universal life insurance, IUL. IUL is a type of permanent life insurance that offers flexibility in both premium payments and death benefit amounts within certain limits. Like whole life, it builds cash value. But instead of a fixed crediting rate, the cash value earns interest linked to the performance of a market index such as the S&P 500. The policy is not directly invested in the market. Instead, the insurer credits interest based on index performance, subject to a cap, a maximum rate you can earn in a given period, and a floor, which is typically zero. The floor means that in a year when the index performs negatively, you are credited zero rather than a negative return. However, policy charges and fees still apply in floor years and can reduce cash value even when no interest is credited. Cash value projections in any IUL illustration are non-guaranteed and based on current assumptions. Actual results will vary. IUL's flexibility makes it a product that some clients incorporate into longer-term financial planning, but that flexibility also requires ongoing attention. Premium changes, loan activity, and market performance all affect how the policy performs over time. So how do you choose? It really comes down to your goals, time horizon, budget, and overall financial picture. And that conversation is best had with a licensed insurance professional and your financial advisor together. Term life addresses a specific coverage need at lower cost. Whole life provides permanent coverage with predictable cash value growth. IUL offers permanent coverage with cash value linked to market index performance, subject to caps, floors, and non-guaranteed projections. No single product is right for everyone. The right tool depends on your situation. If you'd like to explore which type of coverage makes sense for where you are right now, visit us at crossfield.partners or reach out directly.